It's Dividend ETF battle time! On one side, we have SCHD, the dividend darling of many investors. On the other, VYM Vanguard's High Dividend Yield ETF, another heavyweight in the space. If you're trying to decide between these two for your portfolio, you're in the right place. Let's compare SCHD and VYM head-to-head to see which might be the better choice for you in 2025. Strategy and holdings. First, understand that SCHD and VYM have slightly different approaches. CHD selects 100 stocks based on not just high dividends, but also quality factors, strong financial metrics, consistent dividend history. It's more selective and concentrated. VYM casts a wider net. It tracks an index of about approximately 400 stocks with above-average dividend yields, basically the higher yield half of the U.S. market. It doesn't explicitly screen for quality, it's more about broad exposure to high-yield stocks. This means VYM is more diversified, roughly 4 times as many holdings as SCHD, which can be a plus for risk management. SCHD's concentration means it puts more weight in its top holdings. For example, SCHD's top 10 stocks make up about 45% of the fund, whereas VYM's top 10 might be around 30%. Neither is extremely concentrated like a sector fund, but SCHD will have a bigger impact from each stock it owns. Sector tilt. Because of their methodologies, there are some sector differences. CHD often leans a bit more into sectors like industrials, technology, but mostly mature tech like Cisco, not the mega-cap growth darlings, consumer staples, and financials. But crucially, it tries to balance sectors and avoid overweighting anything too heavily. VYM, being market cap weighted and yield focused, tends to have a larger weighting in financials, big banks, etc. And energy, oil companies often have high yields relative to SCHD. It also includes some utilities and telecoms that meet the high yield criteria. SCHD might skip some of these if their fundamentals aren't strong enough. For example, at times, VYM has held lots of utility companies, which yield high but don't grow much, whereas SCHD might favor a slightly lower-yielding tech stock with faster dividend growth. This brings us to yield and dividend growth. As of now, SCHD yields more than VYM. Based on SEC 30-day yields, a standard measure, SCHD is around 3.9%, while VYM is around 2.6%. That's a notable difference. SCHD provides more immediate income per dollar invested. Why? Because SCHD's stock picks currently include quite a few companies with 4-5% yields, like PepsiCo, Chevron, etc., whereas VYM's broader approach includes some slightly lower yield stocks and many more holdings, diluting the yield a bit. However, yield isn't everything. Dividend growth rate is higher in SCHD's portfolio historically. SCHD's emphasis on quality and dividend sustainability means it often holds companies that are growing their dividends at a healthy clip, often high single-digit or double-digit percentage increases each year. VYM, with more utilities and slow-growth firms, tends to have a lower aggregate dividend growth rate. The result? SCHD's income stream might grow faster over time, helping your yield on cost rise, whereas VYM gives more exposure to stable but slower-growing dividends. Past performance, let's talk total return, price appreciation plus dividends. Historically, SCHD has had a slight edge here. Over the last decade, SCHD delivered about 10.9% annualized return versus VYM's approximately 0% per year. Not a night-and-day difference, but SCHD's focus on stronger companies appears to have paid off with a bit more growth. In fact, over 3, 5, and 10-year periods, SCHD has generally outperformed VYM in total return. One reason is that companies in SCHD not only pay dividends, but also have tended to increase in value more, thanks to earnings growth. Whereas VYM holds some stocks that may have high yields but limited capital appreciation. That said, there have been periods where VYM did better. For example, very recently, during some of 2022-2023, VYM held up slightly better when certain sectors like energy outperformed, and some of SCHD's picks, like certain financials or tech, lagged. But the performance gap has not been huge or consistent. These two funds often move similarly given both are large-cap value tilted. Think of it as SCHD being a bit more optimized for total return and dividend growth, while VYM is a broader take on high dividend stocks. Costs, here they're evenly matched. Both have super low expense ratios, 0.06% for each. Essentially negligible fees, kudos to Vanguard and Schwab for keeping costs down. Both are very large. VYM and SCHD each manage on the order of $60+ billion in assets. So liquidity and trading spreads are excellent. In practical terms, cost won't be a deciding factor between these two. Which is better for you? The answer may lie in your priorities. If you want a higher starting yield and can tolerate a more focused portfolio of 100 stocks, SCHD might be the better pick. It's often lauded for its smart strategy and has a strong track record. CHD might also be preferable if you value dividend growth. Reinvesting those growing payouts can compound nicely over time. If you prefer maximum diversification, spreading your bets across many more companies, and a truer value approach, catching all the high-yield names, even those SCHD filters out, then VYM is attractive. VYM's yield is a bit lower now, but it's still substantial. And some investors like that. It's more of a one-stop exposure to the high-dividend universe without additional screening. It's worth noting that SCHD and VYM actually complement each other fairly well. Their correlation is high. Both track U.S. dividend stocks, but the differences in holdings mean owning both gives you a very broad set of dividend payers. Some folks do split money between them for the best of both worlds. SCHD for quality tilt, VYM for breadth. One more point. How about in 2025's market environment? With interest rates and inflation in flux, dividend stocks are on investors' radar. If we see a market rotation into value stocks, both funds should do well. But SCHD's concentration in higher quality names might help it outperform, as it has in some past value cycles. Conversely, if a few sectors, say financials or energy, really take off, VYM's broader exposure there could give it a boost. For example, in an oil price boom, VYM holds more energy companies than SCHD does, so VYM might benefit more. Bottom line, SCHD has a slight historical performance edge and a higher yield, making it a favorite for many dividend investors, myself included, if I may admit. VYM is a solid choice, too, classic Vanguard style, offering broad, no-frills exposure to dividend stocks. Neither is a bad choice by any means. It truly comes down to whether you value SCHD's focused strategy or VYM's sheer diversification. Outro. In the SCHD versus VYM showdown, the winner depends on your investing style, but either way, you're getting a low-cost, dividend-rich ETF. Do you lean towards Team SCHD or Team VYM, and why? Let us know in the comments. There's a lively debate around these two. If this comparison helped you out, please hit that like button. And be sure to subscribe for more ETF comparisons and investing videos. Thanks for watching and happy investing.